Hello, this is Beast McFeast, and today we're going to talk about how to do the poor man's covered call, often written as PMCC. If you find this useful, go ahead and like or subscribe, or say something in the comments. Let me know. So today we're going to look at what are the account requirements of the PMCC, some important Greeks, what to look for in an underlying, how to set up the trade, and when to exit the trade. I'll demonstrate this for you with SPY. Before we get started, I want to be clear. I'm not a financial advisor, and I do not endorse any specific tickers, investments, or investment strategies. Investing involves risk, and you should know your risk tolerance. Basically, the PMCC is purchasing a long-dated call known as a LEAPS. This will be your long leg because you've purchased it. You're long on it. And when you purchase this, you're looking for as many days as you can afford, essentially. I generally don't run a poor man's covered call unless I plan on buying a LEAPS for at least 400 days. Once you have your long leg, you can then sell a call using the long call as collateral. This, when you've sold, is going to be your short leg. This will bypass the need for 100 shares typically seen on covered calls. And it's a lot safer than a naked call. Now, some of you out there might ask, Beast McFeast, why would I want to do this? Well, let's say that an underlying is just too expensive for you to buy 100 shares, or would just throw the balance off in your account. All right, well, you can get a long-dated call for much cheaper than 100 shares. It's always going to be less. Or let's say you want to sell multiple calls for the cost of one covered call. I mean, that's completely possible with this method. Or maybe you just happen to have a long-dated call sitting around and you say, well, I'd like to lock in some gains on this thing that's gone up. How can I do that? Well, you could sell a call against it. The basic requirements for a PMCC is a marginable account with level 3 options privileges. Now, most brokers will call it level 3, other ones will call it something different, and the levels may vary depending on your broker. But you can call them and ask them what is required for calendar spreads, because this is pretty similar. The Greeks we're going to discuss are delta, theta, and vega. Delta and theta are by far the most important in this, but vega can play a small role. Essentially, delta is important because you're relying on your long leg delta being higher than your short leg delta. And I'll show you this in an example. Essentially, it's hard to mess this up if you sell the short leg at a higher strike than the long leg. You could also sell equal delta between long and short, but you'd be at risk because you've then sold a short leg at a lower strike than your long leg, and you would be on the hook for the difference. Theta is the theoretical daily cost of an option contract. So when you're long on an option, it will have a theta value, and that is what that option costs you per day. The PMCC is a positive theta strategy, meaning that you will collect, essentially, theta value over time. And you can quantify this in dollars per day if you want a rough estimate, and I'll do that in the example. How that works is the short leg will have a higher theta value than your long leg, sometimes by quite a lot, meaning you collect the difference. Finally, vega is how sensitive an option price is to implied volatility. We will use this to leg in possibly. It's nice to buy a call, your LEAPS, when volatility is low or the underlying has had a pullback for a couple days. This will let you benefit from a cheaper option due to lower volatility and lower delta at the same strike. If you want to know more about how to use the Greeks in your trading strategy, go ahead and click the card at the top of the page. What should we look for when we are choosing an underlying for the PMCC? I think the first thing you need to look for is probably pretty simple. Pick one that you anticipate will go up in value over the next 1 to 2 years because you're going to have a long leg for that period of time. You want the underlying to be highly liquid, so go ahead and check the open interest and see if the bid-ask spread is small enough that you're satisfied with it. The underlying should offer good premium, which requires it to move some. So don't pick a stagnant underlying, otherwise you won't collect much of anything at all. Finally, weekly strikes are very nice, but not really required. Weekly strikes will greatly increase the rate at which you collect premium. And we'll demonstrate that with SPY here in a minute. So how to set up the trade? Well, try to buy the long leg when the underlying is down for a day or two. And if you're patient and it bounces back a little bit, you can then sell the short leg for a higher premium. Because buying the long leg on a decline results in some free delta when it recovers, which is pretty nice, and it'll save you a little bit of money. You want the implied volatility of the underlying to decline with time, though this is not required. So some underlyings, you'll see that further out options have increased implied volatility. Those might not be the best because they'll just slow down how quickly you collect premium, but they generally will still work. You're going to need plenty of delta on your long leg. I go with no less than 50. Some people have a minimum of 75. Others recommend 90. Now, this increased delta will cost you, so be mindful of that. I think what's more important than delta very often is at what strike are you buying the long leg. You want to ensure that selling the short leg will provide you enough premium that you're willing to continue doing it. Finally, you want to keep in mind that if you were to go and buy an in-the-money leaps, you're likely to recover a lot of that value because it is intrinsic to the value of the contract. Now, this still costs more than an out-of-the-money one and an at-the-money one, which in my opinion works just as well. So let's set up SPY as an example. These are screenshots from when SPY was just below 434. And what we're going to look at first is the long leg. And for the long leg, we're going to select the 435 strike, which gives us a delta of 54, so right in the range I like it. And it's going to cost us $40 a share or $4,000. Notice that it'll cost us about $4.50 a day to hold it. So if we were to do a traditional covered call, we would have to buy 100 shares of SPY, which has a lot of risk to it and costs $43,000, a little bit over, or one of these 480-day 435 strike calls for $4,000. Or if we were really feeling gutsy, we could buy 10 of them for the price of 100 shares and still save some money. And what are we going to do with these? Well, you can choose to sell calls against all or just a few of them. It's up to you. We're just going to use one as an example. So if I was going to do this, I would sell one of the calls in this highlighted range, 435 through 437. And this is for a 3-day call. So we'd be short on this for 3 days. That's the length of time we have the risk. After that, we can roll out to further strikes. Or if the underlying comes up and threatens our strike, we can then roll up and out to keep our short leg intact. So to start, I like to turn the long leg into a calendar spread by selling the 3-day call at 435. You could also turn it into a diagonal spread by selling the 437 strike. And that's more what most people think of with the PMCC. But I like to start with the lower strike, the strike equal to the one I bought, because I can roll out later. So the return on the 435 is going to be $318 or $318. That's not bad. Theta on this is going to be about $41. So that's pretty great. That equates to about $41 a day in your pocket. Although we can tell the realistic number is going to be much higher because we have $300 divided by 3 days. So we're really looking at about 100. But we're going to stick with the written number. For these 3 days, you would have a net theta of $36.91 because it is the short theta minus the long theta. That's how much you would net. Now, we could do the same thing at 29 days, and that's completely reasonable. This would net you a return of $886 on your original $4,000 investment in 30 days. That's a pretty good return. The net theta on that is going to be a lot lower, though, at 11.02. So you notice that selling the weeklies gives you more rapid return. You could conceivably sell these 3-day calls 100 times before the life of your long leg expires. Let's say that SPY increases in value, which I hope it does. We're going to roll up and sell a higher strike. If this happens too quickly and it starts to threaten your short leg, then you can roll up and out in time. So further out in date and up to a higher strike. Ideally, you would do this for a credit while also keeping your long leg intact. The idea here is not to get assigned. And if SPY increases, not only would you collect a greater credit at still out of the money strikes, but your long leg would increase in value. So you can see this becoming very profitable quickly. So let's talk about exiting the trade. If your short leg starts to get threatened by the increasing underlying and it's near expiration, you really want to roll it out or buy it back so you don't get pinned by an aftermarket move. This can be shockingly expensive looking if it happens. That being said, you would just exercise your long strike and get the intrinsic value out of that to cover that cost. You want to always try to roll for a credit. I try to look to roll after I've collected about 50% of the maximum of profit. Unless the roll is not profitable, then I'll wait another day or two and try again. You want to consider exiting when your ability to collect a high theta declines a lot. This tends to happen after several hundred days when theta decay increases on your long leg. So typically around 160 days left on your long leg, you'll start to see an increase in daily cost to hold it. And then around 90 to 60 days, that increase will ramp up significantly. You probably want to be out of that trade, maybe rolling out that long leg again. This still gives you plenty of time to sell premium against your leaps. So some things for your short leg. Always sell at or above the strike of your long leg. Otherwise, you're going to be on the hook for the difference in strikes and the intrinsic value of the short leg. And don't sell your short leg below your break even if the short is anywhere near to being in the money. So calculating a break even is pretty simple. You should do that and try to sell above it. This will reduce how much premium you get, but also be much safer for you. And keep in mind that your break even changes over time as you collect more and more premium. So after I were to sell, I don't know, one of those $800 short legs, that would reduce my break even distance from my long strike by $800. So the strategy overall is not very difficult. I made this pretty technical, more than I had to really. Next time I might just make a video where I show you how to do it a couple times and that's it. But I wanted to give you an idea of why this works, and that requires some knowledge of the Greeks. Thank you for watching. Go ahead and leave a comment, question, ticker recommendation, upvote, or just hit subscribe, whatever you'd like. Good luck. Get rich. Bye.